Ed, you have great charts here for us as always, and somewhat complex as always, so let's dive into them. I want to start off with generally what we know about the stock market's historical relationship between yields and stocks. What does a rising yield and an expanding yield curve mean?
Well, where we are now with a historically moderately upward sloping yield curve is actually positive for stocks. If you look at the spread between the 10-year Treasury and the 2-year Treasury, which is what most people think of when they think of the yield curve, if it's between 0 and 150 basis points, that's when stocks tend to do the best. And stocks tend to do better than bonds or cash in that environment. So we're still in the sweet spot. The issue is that, interest rates are so low by historical standards. If you want to look at what happened 20, 30 years ago, it may not be the best comparison. But what we found is that since the financial crisis, you've had these hiccups in yield or tantrums, starting with a taper tantrum in 2013. We've had a handful of these. And if yields back up too quickly on the long end, that's when stocks run into trouble. What we've seen so far, about a 22 basis point increase in the 10-year over a week or so, that has not been enough. I think if we were to get, say, above 130, approaching 150 on the 10-year in short order, then I think that's when it's going to really hit the stock market. But until then, if it's a generally slowly steepening yield curve, stocks should be okay.
So there's a little bit of a sweet spot in history between 0.6 and 2.5% between that spread that you've got there, where there's clearly some outsized gains in the S&P 500. If we look at Ed's table again, just real quickly, I want to make sure that soaks in for people. I mean, that's a big difference. And this goes well with the conversation we had with Meb Faber earlier this morning, who was talking to us about stock valuations, saying that, well, stocks often do well off of low yield levels because the valuations in history have been at lower levels then too. But of course, that's not the case right now. And it seems the question maybe for us right now is about the speed at which the 10-year can move. Everyone on here never forgets to tell me that the yield can't move quickly. So I guess it's not a question of if, but what if, and let's do a hypothetical. Let's just say it does. What does history tell us then?
Well, it means that the broad stock market's going to get into trouble, or we could get a correction in the broad market. But then what you would see too would then be a lot of the sectors that are particularly sensitive to rising rates would get into trouble too. The bond proxies in particular. So I think we'd want to be careful. And then if on the other side, if the rate back up is so quick that it actually slows the economy down, that's when the cyclical sectors would get into trouble. So it'd be a multi-phase process if we do get to that point, because at that point, if we start talking about hypotheticals, where we would be the Fed would probably get behind the inflation curve, and that's a situation we haven't seen in a while.
Now, Ed, what's interesting right now is even within this short-term move, we pull up the chart where you have yield spikes as kind of displayed through the difference between the yield right now and a 70-week regression. So in the middle panel there, the top panel is the S&P, middle panel is the 10-year yield with the rolling 70-week linear regression, and the bottom one shows us where we are relative to that. I mean, obviously we're coming off like close to zero, but this is already looking totally unprecedented.
Yeah, so this is where I was talking earlier about what's happened since the financial crisis. You've seen on that chart a few times when that bottom section has gotten very high. That is, 10-year yields have spiked relative to where they had been over the past year and a half or so. Mm-hmm. And that's when the rally in the market has paused. And you're right that we're coming off of such low levels that the backup in yields since the August record low in the 10-year has caused that to move very, very quickly. It hasn't slowed the market rally yet, but if this keeps going, again, we're looking at around 130 or so on the 10-year in short order. If we were to get above that point, then I think that chart's going to become particularly relevant for the broad stock market.
So I guess it's another chart that has been skewed in a big way by this crisis. I mean, the percent change off the average, when you're close to zero, dividing by zero obviously gets a little weird. So the thing moves really quickly to the upside. I'm curious about the other statement, though, that it hasn't shown up. Has it? I mean, we were just talking about the FANGs. They all peaked in September, which is shortly after this yield bottomed out.
We have seen a little bit of a rotation, haven't we? And I think that has to do with a lot of congruent factors with the economy looking like it's going to be reopening. That's a reason for yields to rise, and that's a reason to get out of the COVID trade and into the reopening trade. And if you want to look at the COVID winners, the FANG Plus stocks were certainly among those in there. So this is becoming a story of rotation into small caps and into cyclical sectors, and that's something that has been happening and probably is going to continue to happen for a while longer.
You mentioned a few levels for the 10-year yield to keep our eyes on when this might start to show up a little bit more. It seems like it's a combination of level for the yield and how quickly it moves, where maybe we can slowly grind our way, and if we get to 2% by the end of the year, it doesn't ever cause any problems for us. But if we're at 1.1 right now, what do you think, Ed, in terms of what the history tells you? What kind of jump would be problematic? What if we go to the highs of the March candle in the 10-year yield at 1.28? What if we do that in like a week or something? I mean, we went from 95 to 1.1. It seems reasonable. We might be able to go from 1.1 to 1.3 in a couple days or a week. What would that mean?
That's the kind of concerning move we're talking about in terms of hitting the broad market. If it is a grind higher accompanied with stronger economic growth, then the higher yields will be justified. But if it's a shock to the market, we'd have to reassess what Med Faber was talking about earlier, that relationship between stock earnings yields and bond yields, and maybe these high valuations in the stock market don't look as attractive relative to bonds. Then asset allocators are going to need to reassess how their portfolios are positioned, and that could be a bigger problem. But that's going to be something that would have to happen over a short period of time, and again, not associated with better economic growth.
And so far, it seems that even if this yield situation has shown up in markets, it's been mostly as kind of a wedge and not a suppressant. It's just kind of wedged the growth and the value dynamics, along with some of the other factors that you mentioned. There's a lot of cross currents right now. But I really like your chart that looks at the Russell 1000 value versus growth, because here it suggests it's more about growth slowing down than value really taking off. What does this relationship tell you right now?
Well, I think what we're seeing now is that growth stocks are hanging in there okay,
right?
And value is just doing so particularly well. So what this chart is showing is a relative performance of growth versus value. It's large cap growth value in the top, small cap growth value in the bottom. So when those lines are going up, growth's outperforming. When they're going down, value's outperforming. So you've seen value has done a little bit better over the past couple of months, but they haven't broken down. There's some pretty interesting support levels that these growth value ratios have hit over the past few months, have not broken below those. So until we do, I'd say this is a battle back and forth between growth and value, more so than a really powerful all value performance. And part of that is that we think about value, and we think about energy, and we think about financials. That's very true, but also staples, utilities, real estate. Those sectors have big weights in the value benchmarks, and those have high dividend yields, and they've gotten hit really hard here on a relative basis. And so that's why the dynamic within growth and value isn't as simple as it first appears. This is really about cyclical versus defensive, more than just, say, a growth versus value. Okay.
Now, I think also the message here, and I like the point that growth has been hanging on, right? I mean, we have seen some of these really, really frothy moves, exponential, parabolic charts in the category of growth, and all that has basically been to make a draw with the value side, as we saw in that chart. If we pulled up again, just for the perspective, is we're at the support area. So if the relationship does break below, it seems like, Ed, this value outperformance hasn't even really gotten going yet. It seems like it's, right now, if investors are still buying up growth companies, and this chart and the relationship hasn't rolled over and broken that support, to me it seems like when we do, I mean, the growth value spread, if you're trading that, is going to be a huge event.
Yeah, this is a 1 year view. If you were to take this back 5, 10, even 20 years, you'd see just how huge the growth outperformance has been. And so once this rotation gets going in earnest, this is going to be a huge trade for value. It's going to be something that happens once every decade or so. And so, we're getting close to that point. But because growth has they've had these head fakes before, you don't want to try to jump on every single one. I think there's been a lot of strategists out there. Every time value catches a bid, they declare the end of the growth bull market, and up to this point, they've been wrong every time. So let's make sure this is the big move, because eventually it will be. But we don't want to jump the gun and be the next round of premature and calling the premature end of the growth bull market.
Okay, so nobody wants to get fooled thrice, right? That's the rule. Maybe it's twice. Ed, last one.
6 or 7 at this point.
Yeah, the count is a lot higher now. Hey, Ed, just a last thought here. I want to make sure we pull up this last one that just kind of looks at the sectors as defined by their exposure to some of these trends. The size of the bubbles or the weight in the Russell 3000, the broad all-encompassing index for stocks. And then the weighting determined by how overweight they are in terms of cyclical versus growth. Right now, the bubble way out there looks like banks, it looks like industrials, and it seems like tech is really the only one way on the right there that just doesn't fit this potential cyclical value rotation.
Yeah, so the further to the right you go, you're a growth sector. Further to the left you are, you're a value sector. The higher up you are in the chart, you're sensitive to the 10-year yield curve. So if the yield curve steepens, you're going to tend to benefit. The further down you are, you want the yield curve to be flattening. And so as the yield curve steepens, the winners are these cyclical value sectors. Financials first and foremost, but also industrials, materials, energy. But then, look at tech there. It's somewhat positively sensitive too, and this is part of the reason why growth hasn't completely given it up yet to value, is that you have this behemoth of the tech sector that actually does okay when the yield curve steepens, and it's a little bit of a counterweight to these cyclical value sectors, which is why I think this is really right now a cyclical versus defensive move, not necessarily a growth versus value move, at this point in the cycle.